without a high school degree are unbanked. The current system is expensive and slow. International and even domestic money transfers can take days. International and even domestic trillions of dollars worth of capital held up at any given time. There are trillions of dollars worth of capital held up at transactions that are not more accessible. Anyone with a smartphone can download a wallet app accessible to send and receive. Anyone with a smartphone can download a wallet app required to send and receive. Transferring digital assets no bank account is required and convenient. Transferring digital assets to receive 24/7 and convenient. There's no waiting around for wire transfers or money orders to arrive. There's no waiting around for wire transfers or money orders to arrive. Transfers are very inexpensive. In some cases, costing just a penny per transfer. At its heart, digital assets can also reduce bias in finance. It is agnostic to a user's race, gender, nationality. Public trust in digital regulation is essential for increasing public trust in digital assets. That's why we sought oversight by a primary prudential regulator. That's why we sought oversight by a primary prudential regulator. Taxos became the first regulated trust for digital assets in the country. Taxos became the first approved by the New York State Department of Financial Services in 2015. When it was approved by the New York State Department of Financial Services in 2015. We adhere to the same anti-money laundering and know your customer rules as banks. We adhere to the same anti-money laundering and know your customer rules, operations, procedures. We are subject to regular examinations of our operations, procedures, and capital also regulated. Of the world's three regulated dollar-backed stablecoins, two of the world's three regulated dollar-backed stablecoins. Unfortunately, the uncertain state of digital asset regulation is hampering the industry's development. The uncertain state of digital asset regulation is hampering the industry's development into a regulatory system designed. From the regulation must ensure that customer assets are held segregated from the company's balance sheet. Independent auditors should regularly attest that assets backed in the token are always held in reserve. Auditors should regularly attest that assets should be held in the token are always held in reserve accounts. Those reserves should be held in bankruptcy and not available to the issuer's general creditors. And available to the issuer and not available to the issuer's general creditors. The adoption of digital assets. If the federal government instead stifles the adoption of digital assets, for more welcoming jurisdictions, talent and capital, that would be a disaster for more welcoming jurisdictions. Both consumers and workers, a disaster for America as a whole. Both consumers and workers, U.S. dollar-backed stablecoins, or a central bank regulated U.S. dollar-backed stablecoins, or a central bank increasingly less viable for other countries and companies. It will become increasingly less viable as the global countries and companies to continue using the U.S. dollar. We need the government support to create a new, more secure, more competitive. We need the government support to create a new, the benefits of getting this right are enormous. Competitive financial system. But so are the consequences. The benefits of getting this right are enormous. Thank you for the opportunity to provide my testimony, and I look forward to your questions. Thank you for the opportunity to provide my testimony, and I look forward to your questions.
Thank you very much. Ms. Dixon, you are now recognized for 5 minutes to present. Ms. Dixon, you are now recognized for 5 minutes to present your oral testimony.
Good morning, Chairman Waters, Ranking Member McHenry, and members of the committee.
Could you move your microphone a little bit closer? Could you move your microphone a little bit closer?
Thank you for inviting me to testify today.
Thank you.
I'm honored to be here. Thank you for inviting me to testify today. I'm the CEO and Executive Director of the Stellar Development Foundation. I'm the CEO and Executive Director of the Stellar Development Foundation. I took this role and joined the blockchain industry more than 2.5 years ago. And joined the blockchain industry. Prior to that, I was the Chief Operating Officer of the Mozilla Corporation. Prior to that, I was the Chief Operating Officer a lot of my time advocating, among other things, where I spent a lot of my time advocating, among other technologies. Openness and interoperability. It's those same policy priorities that drew me to blockchain. It's those same policy priorities that I believe can learn from past mistakes made in other areas of web development. Can learn from past mistakes made in other areas of web development. Permissionless, decentralized network is an open that is optimized for decentralized network. There is no single that is optimized for payments. SDF. There is no single controls the code base of the network or its growth. That controls the code base of the network or its growth. Just like the underpinnings of the internet, it is ready and available for use to anyone. Just like the underpinnings of the internet, it is ready and available for use to anyone. And especially in the context of this hearing, Stellar was especially in the context of this hearing, making it possible to create designed for asset issuance and trade digital assets backed by nearly any form of value. And trade digital assets backed by nearly any form of value. Built in to help those asset issuers meet their own built-in to help those asset issuers meet their own. The Stellar platform is a pioneer of tokenization, optimized for fiat-backed asset issuance before stablecoin was even a word. And over the last few years, an ecosystem of businesses and users have built use cases around Stellar-based stablecoins due to their incredible utility to solve many of the problems we see in today's payment landscape. Despite the headlines, what's happening in the world with blockchain, with cryptocurrency, and stablecoins is not just lending, trading, and borrowing. Other use cases are active and focused on solving real-world challenges using the technology. So let me start with Moneygram International. Moneygram is building a solution on Stellar that enables seamless conversion between cash and digital assets. Moneygram's network integrates with the Stellar blockchain to enable cash funding of digital accounts and payout in different currencies of the consumer's choice using stablecoins. It's using Circle's USDC coin. In real terms, consumers will be able to send value in the stablecoin and easily convert to local fiat currency for instant pickup of thousands of participating MoneyGram locations globally. This is in pilot phase right now in the US and is expected to be widely available in 2022. Another example, Leaf Global FinTech has built a solution for refugees and cross-border goods traders who are vulnerable to theft while carrying across borders. So with Leaf's wallet, these users can save their money in multiple currencies, benefit from cross-border transfers, and pay for goods and services. That functionality is only possible because they leverage Stellar's ability to issue assets, to issue stablecoins, and exchange value with low transaction fees and high speeds. This use case is live and operational today. The last use case I'd like to touch on is one that is in development. Tala is best known for its mobile lending app, which enables its customers to apply for a loan and receive an instant decision, regardless of their credit history. Tala is now working to expand their offering by using Stellar assets and stablecoins to help their current customers with credit by allowing borrowing, spending, saving, investing, and sending and receiving. There are many more valuable use cases in the Stellar ecosystem that I would love to be able to share with you today, but I would just briefly like to mention that in a recent report from the G20 and IFC, there were 5 Stellar ecosystem companies named for their innovative solutions in digital finance supporting MSMEs. Use cases like these are in varying states of maturity, but their current and potential value is undeniable. And none of these use cases would be possible without stablecoins. Stablecoins are a core technological component, and by extension, that means stablecoins are essential on delivering on financial inclusion. So that brings me to the PWG report on stablecoins. The PWG report raises legitimate risks, but its recommended solutions, they go too far. Specifically, to limit stablecoin issuance to insured depository institutions is not narrowly tailored to the actual risk of stablecoin arrangements for the simple reason that although there are outliers, most stablecoins, unlike bank deposits, are fully reserved. Instead, we advocate for a regulatory approach that it focuses more on stablecoin reserves by requiring stablecoin arrangements be fully reserved by appropriate assets, requiring reserves to be held as insured depository institutions, creating clear standards for regular audit and public disclosure of stablecoin reserves and key contractual terms regarding redemption, and by making it clear that payment stablecoins are not securities. Of course, regulators must be empowered to oversee these requirements. The framework should allow oversight through state banking supervision or a narrowly tailored charter of the OCC. In our view, this would promote the safety and soundness of stablecoin arrangements. We've started to see how innovation can be hampered in other parts of the world when regulators and lawmakers react prematurely. In Nigeria, stablecoins and blockchain technology were eliminating costly foreign exchange and transaction fees and slow processing times until the Central Bank of Nigeria abruptly ended that business model. And many innovators had consequently been stopped in their tracks. As we walk away from this hearing, I urge you to look at the industry and technology beyond the narrow lens of applications that often dominate the news. Thank you for having me here today, and I look forward to your questions.
Thank you, Ms. Dixon. Ms. Haas, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of this committee, good morning, and thank you so much for this opportunity to testify on digital assets and the future of finance. My name is Alicia Haas, and I serve as the Chief Financial Officer of Coinbase Global. I also serve as the Chief Executive Officer of Coinbase Inc., our U.S. subsidiary. I joined Coinbase in 2018, formerly was Chief Financial Officer of Sculptor Capital and One West Bank, and spent 20 years in the financial services industry. Today, I'm here to introduce Coinbase, talk about the evolution of crypto, and highlight today's regulations and how they could be changed to advance bipartisan goals of protecting consumers and promoting innovation. Coinbase's mission is to increase economic freedom in the world. We were founded in 2012 with the idea that anyone, anywhere, should be able to easily and securely send and receive Bitcoin. Over the last 9 years, our products and services have expanded to meet our customers' needs in the rapidly evolving crypto industry. We have customers in every state except the state of Hawaii, and as a remote-first company, we have employees in 45 states and in the District of Columbia, including 24 of the 25 states represented by this committee. We now securely store 12% of the world's crypto on our platform. This is across over 150 asset types, and we offer customers the opportunity to learn, to sell, to resend, to receive, and buy more than 100 assets on our platform. Additionally, we offer customers the opportunity to spend, to borrow, to earn, to stake, and transact on select assets. We serve more than 73 million customers globally, including 10,000 institutions and 185,000 application developers. Importantly, nearly 50% of our transacting customers are doing something other than buying and selling crypto, which indicates to us that crypto has moved past its initial investment phase, and we are now in the long-expected utility phase of this ecosystem. Since our founding, Coinbase has strived to be the most secure, trusted, and legally compliant bridge to the crypto economy. Coinbase is federally registered as a money services business with FinCEN, licensed as a money transmitter in 42 states, holds a BIT license and trust charter from the New York Department of Financial Services, and we are authorized to engage in consumer lending in 15 states. We have a robust AML/BSA program, and we are one of only 2 digital asset members of the Department of Treasury's Bank Secrecy Act Advisory Group. In addition to the various state regulatory regimes, we are subject to federal oversight from Treasury, the CFTC, SEC, FTC, and CFPB. Much like the adoption curve of the internet in the 1990s, we are seeing dramatic advancements in crypto participation. There are more than 220 million crypto holders globally, and around 16% of Americans have invested in, traded, or used cryptocurrency. Total crypto market capitalization at the end of the third quarter was over $2 trillion, up from $800 billion as of the end of 2020. Coinbase's platform is powering the crypto economy, a new financial system for the internet age, which we believe is a critical infrastructure layer to Web 3.0. Technologies like non-fungible tokens, which we call NFTs, and decentralized application platforms will lead the way to Web 3.0, which will revolutionize the internet. Much like the industry was revolutionized when it went from static content to the dynamic engagement content we have today. We believe sound regulation is central to fueling crypto innovation and adoption. That is why we introduced our digital asset policy proposal, which we refer to as DApp. The DApp assessed the challenges of the existing regulatory framework and proposed a 4-pillar solution. First, we believe the government should recognize digital assets under a new, comprehensive framework that recognizes the unique technological innovations underpinning digital assets. Second, the responsibility for this new framework should be assigned to a single federal regulator. This regulator would be charged with establishing a registration process for intermediaries, which we refer to as marketplaces for digital assets. Third, this new framework should have 3 goals to ensure holders of digital assets are empowered and protected. A, We believe in enhanced transparency through robust and appropriate disclosure requirements. B, we want to protect against fraud and market manipulation. And C, we want to promote efficiency and strengthen our market resiliency. Our fourth and final pillar is to ensure that regulatory solutions promote interoperability and fair competition. In conclusion, Coinbase believes crypto will drive transformational change across society in positive ways. This is why our mission is to promote economic freedom around the world. Disruption always challenges the status quo, but we believe sound policies can improve the system for everyone. We applaud Chairwoman Waters, Ranking Member McHenry, and the members of this committee for holding this important hearing. Thank you for the opportunity to discuss these important issues, and I look forward to answering your questions.
Thank you very much. I now recognize myself for 5 minutes for questions. Mr. Casarella, I'm a bit concerned about your company, Paxos's partnership with Facebook, which is now calling itself Meta. As you know, Facebook has attempted several times to enter the cryptocurrency market. Starting in 2019, they founded the Libra Association, based in Switzerland, with the goal of creating a stablecoin, but suspended its activities after this committee held hearings, and I, along with other members and U.S. regulators, raised significant concerns, leading to a number of Libra Association members pulling out. Now, in partnership with Paxos and Coinbase, Facebook has launched a pilot project with its digital wallet, Nova, for a limited number of individuals in the United States and Guatemala to send and receive money using your stablecoin known as USDP or Pax Dollar. As you know, one of the recommendations in the recent President's Working Group report focuses on mitigating systemic risk posed by stablecoins, as well as concentration of economic power concerns. The report, among other things, recommends legislation that stablecoin users must comply with activity restrictions that limit affiliation with commercial entities, similar to restrictions most banks face to promote the separation of banking and commerce. While your partnership with Facebook is reportedly a pilot limited to a number of users in Guatemala and the United States, what is stopping Facebook from the future allowing its nearly 3 billion monthly active users to make payments and save funds with a Pax Dollar or other previously issued stablecoin through a Nova wallet? If this were allowed at such a scale, how would this not undermine the U.S. dollar and the world's reserve currency? Casarella, are you still muted? Can you hear me?
There we go. Sorry about that. Thank you for the question, Chairwoman. I think it's important to note in the case of Novi that they are a customer of Paxos, just like any other customer of Paxos. We have an open product. They could use that product in the open market. They decided to come to Paxos, and I think they did that because we have the most regulated stablecoin product. And I think that was an important decision for them, that they wanted to use a well-regulated product. And I think another important point here is Novi is our customer. That's a subsidiary of Facebook Meta. But Novi itself is a regulated money services business. They are regulated to operate in almost all states in the United States. And we have done extensive due diligence on their controls and the regulatory oversight that they have. And we feel very confident that they're following those. And so in terms of the Novi usage of our product, it's just like anybody else, just like if they had a bank account, which they do, and they were using. And so in that way, the services they're getting from us are no different than services they get from any other financial institution that they have a relationship with.
And so this is supposedly a pilot that's limited to a number of users in Guatemala and the U.S. What is stopping Facebook, again, from in the future allowing its nearly 3 billion monthly active users to make payments and save funds with a Pax Dollar or other privately issued stablecoin through a Nova wallet? How long is this pilot pilot. Can you describe it?
Yes, the pilot's limited and controlled. It's something that we work together with our regulator on, and they have reviewed our program. Novi would be best position to talk about their plans to expand it. But right now, they're in a pilot phase. It's just the U.S. and Guatemala. It's quite limited in scope and size.
I now recognize the gentleman from North Carolina, Mr. McHenry.
Well, thank you.
Who is the ranking member of the committee. You are now recognized for 5 minutes.
Thank you. Mr. Brooks, let's step back from digital assets and blockchain for a moment. Let's talk about where the internet was, where it's come to, where it's going, right? We're trying to level set here for policymakers. So originally, the internet was a read-only format, in essence. We're consuming information. And then there's additional layers that we place on. It became much more interactive. But counterintuitively, much more interactive, but much more centralized in Web 1, Web 2. What we're hearing now is Web 3. Policymakers need to understand the nature of Web 3. This is a hearing about a component of Web 3. Now, along those lines, what are the characteristics that defined Web 1 and Web 2?
Mr. McHenry, thank you very much for that question. I think that's critical to understanding what we're all trying to build here. So the characteristic of Web 1, if people remember their original AOL account, was an ability to look in a curated walled garden at a set of content that was not interactive but was presented to you on AOL the way that Time magazine used to show you the articles they wanted you to see inside of their magazine. Just you could see it on a screen. The innovation of Web 2 was that suddenly you could not only read content, but you could also write content. This is when the blogosphere became a big thing. People remember this from the late 90s, the early 2000s. The reason for the centralization of the internet, of course, was that all of that activity was being monetized by a very small number of companies. Facebook, as the chairwoman mentions, Google, and 2 or 3 other companies. What makes Web 3 different is the ability to own the actual network. And that's what crypto assets themselves represent, is an ownership stake in an underlying network. So when you hear people talk about, for example, layer 1 tokens, what they mean is this is your reward for providing the ledger maintenance services, the computing power to the network that on Web 1 and 2 was done by Google, right? So now people in my hometown of Pueblo, Colorado can actually own the Ethereum network, but they can't own the internet. That's owned by Google and a few other companies. That's what the project of crypto is all about, is allowing people to directly own the networks that have native assets that are supporting it, and that's the nature of decentralization, where the token holders are the people who control the asset, not
so
Google.
Token holders, for our language here on the Hill, those are digital assets, right? Which are the keys to open up the ledger for you to participate, right? So describe to us how those digital assets fit into this internet revolution, Web 3.
So the concept is that you have sort of application layer tokens and you have protocol layer tokens. So if I'm an owner of Bitcoin, let's say that I'm a miner of Bitcoin, somebody who actually creates Bitcoin. The Bitcoin is the reward I receive for doing the work to keep the network operational, and that allows me to own a piece of the Bitcoin blockchain. Or take Ethereum, which is easier to understand. The Ether token represents an ownership stake in the network, but on top of that network are all kinds of apps that get built on the network, much like the apps on your phone depend on the underlying network existing that lets the phone operate. And so people will make judgments about which network is likely to win, and they will invest in the tokens in that network much the same way you might invest in Google stock because you think Google is going to scale access to the original internet. The difference being here, you can vote on what happens in the future of a proof of stake network, for example. You can get rewarded through a proof of work token for maintaining a ledger on something like Bitcoin. But the real message here is that what happens on the decentralized internet is decided by the investors, versus what happens on the main internet is decided by Twitter, Facebook, Google, and a small number of other companies.
Okay, so getting this layer on digital assets right, for Congress to understand this, everything is built upon that on-ramp to this new internet. So very important for us to be sensitive to how this develops and any actions we take in terms of laws and updating laws to incorporate these new technologies.
Yeah, Mr. McHenry, couldn't agree more, and I think when you hear about all of the problems of different big tech companies, the importance of an owner-controlled network becomes clear.
Okay, owner-controlled network rather than a cooperative, right? And thinking in those terms.
Absolutely.
Right? So if you're not a part of management, you're not making a decision in Web 2. If you are a participant in the network, you're cooperating in the making of those decisions.
Exactly right.
Okay. So I ask this not to be insulting to the panel, but to have a level set here so we have an understanding of what we're talking about. This is not simply about you on this panel. It is about trillions of dollars of assets that did not exist before Satoshi wrote his white paper 13 years ago. It's about $3 trillion in notional value at this stage around the development of a whole new range, whole new suite of technology that will be developed across the globe, whether or not the United States embraces it and wants to compete, or if it's pushed offshore. So as policymakers, we need to understand what we're talking about here. This is a small panel, important as you may be, a small panel about the discussion about Web 3. And so with that, Madam Chair, thank you for having this hearing, and I hope that we can have more understanding by policymakers about these important concepts. Thank you, Mr. Brooks.
Thank you very much. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Thank you, Chair Waters, for having today's hearing. Our financial system has been built up over time, with us learning from each financial crisis, fixing and adjusting as new financial risks come forward. From the Great Depression and the creation of the FDIC and deposit insurance to the Dodd-Frank reforms after the 2008 financial crisis, we may not all agree on every aspect of those laws, but they've made our financial system and our entire economy more resilient, and consumers and investors more protected when things do go wrong. In 2018, the New York Attorney General released a report from its Virtual Markets Integrity Initiative, which detailed a few key findings regarding crypto trading platforms on potential conflicts of risk and interest, lack of serious efforts to stop abusive trading activity, and limited protections for customer funds. The report stated, and I quote, "Customers are highly exposed in the event of a hack or unauthorized withdrawal, while domestic or foreign deposit insurance may compensate customers for certain losses of stolen or misappropriate fiat currency. No similar compensation is available for virtual currency losses." This is not a theoretical concern. In fact, Coinbase was reportedly the subject of a hack earlier this year, impacting at least 6,000 Coinbase customers. Ms. Haas, what happens today for a Coinbase customer in the event of a hack of Coinbase or a Coinbase wallet, or in the event of unauthorized withdrawal? What protections does a customer currently have? FDI insurance, commercial insurance, could you answer that question, please? Thank you.
Yes, thank you so much for the question. So Coinbase does secure 12% of the world's crypto, as I shared with you earlier, and we have extensive controls to protect our customer assets. We bifurcate our assets into 2 different storage systems. We call one the hot wallet, and we call one cold storage. And less than 2% of our assets are held in a hot wallet, which is subject of a cyber attack. Specifically, the incident you mentioned was not a hack of the Coinbase systems, but in that event where customers did lose funds due to other losses, we did reimburse customers for that event. We do protect our customers for any hack of the Coinbase hot wallet, and we have third-party insurance, plus we use our own balance sheet to protect our customers for the event of loss on our platform.
Please pull the microphone closer to you and speak into it so all members can hear you.
Thank you so much for the clarification. With regards to what losses we typically see, though, in the press, we typically see these are account takeovers at the end point where a customer has lost their credentials and then has had a hack of their own phone, their own personal device. And that is unfortunate at this point in time because that loss is not well protected for within the broader crypto economy. that is something that Coinbase continues to study and would look to over time do more to support our users
Reclaiming
for
my
those
time.
losses.
Reclaiming my time's very limited. Is that uniform, the protections you talked about for all crypto exchanges and wallets, or just for yours?
I'm speaking specifically about the Coinbase protections we offer.
Okay, so it's not available to others. So do you think customers could benefit from some uniformity and standardized minimum protections if and when customers lose their funds through no fault of their own?
I do believe there's opportunity there.
Richie? In addition to this committee, I have the honor of chairing the Oversight Committee, and we recently held a hearing on the rise of ransomware and strategies for disrupting criminal hackers. As detailed by a recent FinCEN report, $590 million in suspected ransomware payments were reported by financial institutions in the first 6 months of 2021, and it's getting worse. So it's no surprise to me that these criminals frequently seek payment for ransomware attacks through cryptocurrencies. And FinCEN identified several money laundering typologies for these actors. Ms. Dallaire and Ms. Haas, our anti-money laundering requirements are paramount to prevent fraud, sanctions, invasions, and the financing of terrorism. And you and your companies have highlighted your firm's compliance programs, stating that these standards are important to protect the financial system and to drive trust and adoption. But not everyone in this industry believes that, and many have rejected or avoided compliance standards. Some actively promote themselves on not complying with Know Your Customer requirements. This is an entire financial services ecosystem, and one weak link exposes the entire system to money laundering risks, as highlighted by the FinCEN data I just mentioned. Could you share why your firms have taken your anti-money laundering compliance approach and the benefits of doing so across your firm's products and services? And what steps can we take to bolster our anti-money laundering efforts and ensure all crypto marketplaces comply?
The gentlewoman's time has expired. The gentlewoman from Missouri, Ms. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Ms. Haas, let's continue. SEC Chairman Gensler has indicated on multiple occasions that, and I quote, "The test to determine whether a crypto asset is a security is clear." However, Commissioners Peirce and Roisman noted that they believe there to be an obvious lack of clarity for market participants around the application of securities laws to digital assets and their trading. The lack of clarity is clear through the numerous requests that the SEC receives for these no-action letters. In your view, is additional guidance defining clear rules of the road for investors and market participants needed at this time?
Thank you for the question. We believe this is a very important area of focus for the SEC and this committee. We do agree that the laws are clear. However, existing laws, regulation, and legal precedent make it clear that blockchain tokens are not securities. So we believe that the law clearly shows that blockchain-based digital assets are one of two things: either a new form of digital property or a new way to record ownership, as Brian Brooks spoke earlier about. We do believe that clarity is needed because these are new assets. It's a new way of transacting with these new protocols that we spoke about, and I think it would benefit all of us in the ecosystem to have agreed upon definitions.
I couldn't agree more, and I would hope that Chairman Gensler would be listening to his commissioners and some of the feedback that you all are giving him. You know, we talk a lot about financial inclusion in this committee, and digital assets have the potential to provide fair access to financial services to all Americans, and I believe that Mr. Bankman-Fried brought that up, and many of you did in your written testimony. I'd like to start, and I've got limited time, with Ms. Dixon, and then I think Mr. Allaire. How would digital assets and blockchain technology facilitate financial institutions or financial inclusion and benefit the 1.7 billion unbanked people throughout the world, and particularly the millions here in the U.S.? Ms. Dixon.
Thank you for the question. This is a really important area. Understanding your time is limited, I'll just say that blockchain allows value and money to flow just like email. So it's very simple in terms of how it can get from one point to another, and it does so very, very quickly. The importance of that is it actually can cross borders much more simply than anything else that's out there today. So the value of blockchain is the ability to send from the United States, for example, and send to another country without having to reconcile with all the different software and intermediaries that exist today. So it eliminates intermediaries, it creates less friction in the marketplace, and it allows users who don't have bank accounts today or who choose not to get bank accounts or have been de-risked by banks from being able to be able to access this technology very cleanly because they can do so with a wallet.
Thank you very, very much for that input. And Mr. Allaire.
Thank you, Congresswoman. I think financial inclusion is a critical design goal for many of us, and certainly as we think about USDC, today USDC as a payment technology for dollars on the internet enables users to transfer dollars in a fraction of a second with a transaction cost that can be as low as a 1/20th of a penny, and with the throughput of the Visa network. That's a benefit that can be brought to individuals, and I'd like to really emphasize something for the committee, which is one of the most powerful things about this technology is that it is the open internet. Just like anyone can have an email account or a text message or access the internet, this is an open financial system. And when you combine those kinds of access efficiency and that openness, it creates an opportunity for anyone with a mobile device anywhere in the world to seamlessly exchange value with one another.
Great, thank you. Mr. Brooks, in your